Normally you have to like twist your football.
All right. I think this is on. Oh.
Do you just love it?
No.
It's like a conference. You're out there presenting. Big sales pitch, TED Talk.
It looks like one of the Backstreet Boys with that.
Don't go there.
Totally different.
Yes, I'm definitely not a Backstreet Boy. Can y'all hear me in the back?
We'll never know until you start singing. Never be able to sing definitively.
Okay. For those of you who are in the back who can't hear this, I was told I look like a Backstreet Boy with this thing on. I was the guy that in church, the little old lady behind me, who's usually the sweetest old lady in the world, goes, like, dang.
That really happened?
Thought this was church. You're supposed to be nice to people. Yes, that happened. It wasn't nice. Anyhow, so because I can't sing, we're talking about credit today. So we're going to talk about strategy. We're going to help you understand what you actually look at when you're downloading a credit report, because a credit report is not your credit score, although they're very well linked. Then we're going to go over what makes your credit score, a couple of ways to improve it, and then you'll get questions at the end, although you'll also know in the middle. I'm okay with that. I'm going to kind of stand here and pace back and forth. One, because then I can see more of y'all. All right, let's dive into it. This is the thing that actually someone, I'm not going to name, came in and said, I thought about not coming today until I realized I couldn't think of the definition of credit.
It was me.
I wasn't going to call you out.
I'm shameless. I don't get it.
Okay, fair enough. So if you basically want to think about credit, it's the ability to obtain goods or services before actually making a payment on it. Because if you've got a credit card, you're not paying the person providing those goods or services. The credit card company is. And you're promising that at some point in the future, you will pay that back to them. Credit cards are actually a relatively new phenomenon, but credit itself is not. So credit's been around forever. Like, anyone watch Little House on the Prairie? When Pa Ingalls would go into the store and he'd be like, I'll pay you when the crop comes in. And they'd be like, okay, we'll write it down in the ledger. Well, that was the beginning of store credit cards. Just there was no card, there was a ledger at the store. And they knew everybody. It's why in the old days, and some of you may still hear this from your grandparents, go to the bank and get to know the bankers and they'll give you a better rate. Yeah, no, not anymore. Nowadays, it's all entirely based on algorithms and things like that. But anyhow, so debt, typically it's money, but something that you owe or is due to someone else. You could owe a debt of service. My son right now owes me some chores because I went and bought him some stuff for his lathe that he uses all the time. So he now owes me chores to pay those off. So his debt in this case is not money, unless he comes into some money and wants to pay me cash, and then he'll be out of it sooner. Probably even cheaper. So then we've got two types of debt, and we're oversimplifying this a little bit. Food's over there on the corner, on the side. So there's secured debt. That's debt that's backed up by collateral. It's debt that if you don't pay on it, they can come and take something from you. You've got a mortgage, they take your house. You got a car loan, they take your car. In our house, we don't have it anymore because we paid it off. We had a violin loan. They'd show up and they'd repossess my wife's violin if we hadn't paid on it. Unsecured debt, on the other hand, has nothing physical that they can take from you to back it up. Name a type of unsecured debt that you probably mostly all have. Student loans. Student loans are unsecured debt. Student loans are a really odd category of unsecured debt because they actually have lower interest rates than you'll find on most other types of secured debt. Like right now, your student loans are even lower than some mortgages that people are getting offered on a 15-year mortgage, which is very odd. It used to be parents would offer to take out pay their kids' school because it was a lower interest rate. One, most parents wouldn't do that, but some would. And two, Not the best idea. Nowadays, student loans are kind of the best debt out there when it comes to interest rates for the moment. And then you've got your credit report, which is simply a list of all of your credit and debts and payments and pretty much everything that you've ever done where you've owed someone money. So, good credit strategy. This is just in general. Make your payments on time. If you learn nothing else, learn these things. Do not borrow what you can't pay back. If you're not going to pay it back, don't borrow it. Major exception. Public service loan forgiveness. I am all about that as your don't ask me how I feel about it from a fiscal and then also avoid borrowing at your limits. I don't care if it's a mortgage or a credit card. You don't ever want to be all the way up at the limit. It's generally bad form. Because if you're up at the limit on a mortgage, for those of you who were there last week, they approve us for more mortgages than we can actually pay back in a month and still be able to eat and have heat. You know, you just won't be able to afford it if you're borrowing the max that they say you can borrow. For your credit cards, if you're borrowing all the way at the limit, you're killing your credit score. All right, so do you need a credit card? I heard probably. I heard yes.
It's helpful. Yeah.
It's helpful. I'm going to go with the it's helpful side. They're usually most people's first step into credit. How many of you on your college campuses were they out there offering free t-shirts if you signed up for the credit card? I was the master at coming up with fake information to put on there and get all the free t-shirts. I didn't want a credit card, but hey, it's a free t-shirt. I'm going to the football game. Needed something to wear because licensed football gear is expensive. You know, if you don't have a credit card, do you think you can get access to other credit?
Sure.
Some yeses, some nos. I will tell you definitively yes, but it is more difficult. And if you have one, we'll kind of go over what to do if you already have a credit card later. So I'll give you an example of someone's credit score with no cards, and that someone is me. I don't have credit cards. And what's the max credit score? 820? Is it 820 or 860? I can't remember. Or just 800? 860? So I'm not all the way at the maximum. The big hit on my credit every time they pull a report is, you don't have any credit cards. Like, okay. If you're above 720, you're getting all the prime rates for borrowing anyway. So for me, it doesn't matter. But my credit score hasn't always looked like this. I'm nearly 40. Y'all are not.
You're not 20 years old.
No, I'm not 20 anymore. Thanks for pretending. All right. So, you don't need it, but it does certainly make things better. And I'm not going to tell y'all not to get credit cards. That's something that me and my family did. It is certainly not for everybody. Plus, times are changing. All right. So if you have a credit card, keep it. As long as you're making the payments on it. Why? Why do you think you should keep it if you already have? Of building credit that is. We'll hit it again, the credit score, but anyone know off the top of their head? The length, how mature the account is. The older the credit card, the older the credit account, the better it is as far as your credit score and as far as most lenders are concerned. I'll try and reiterate this later when I get to the credit score itself, but the credit score you look at, generally speaking, is not going to be exactly what your banks are looking at and determining to whether or not to give you credit and extend credit. Every bank has their own institutional method on that. Now, they're still going to give you one of the three major credit reporting bureaus and that reason, but they've got their own reasons for not giving you a certain interest rate or maybe not even giving you. The credit score you see is not necessarily what they're using. Now, if you don't have a credit card, it's up to you. But they're a really useful tool. Like Like I said, in this case, don't necessarily follow me. If you want to, that's fine. No, it's going to be a long, harder road to build up your credit score. All right. So what all goes into a credit report? And basically, it's every single one of these things goes into a credit report. And remember, your report is not your score. So when you pull your credit report, you're not going to have a score on it. The good news is these days, most of our banks are giving us an updated FICO score every single month. I get one from Wells Fargo. I get one from the credit union here at the hospital. Forget South Carolina Federal. That's what we changed to, or got bought out by. So what's the first thing on your credit report? It's who are you? And this is really important. You see all those dispute buttons on the side of this? Like, hey, that may be my name, but that's not my social that gets associated with it. I've got a friend who has an extremely common name. It's not exactly John Smith, but it's pretty close. And he went to go buy his house that he's in right now. And they pulled his credit report, and they're like, well, sir, you've got this home in Oklahoma that you haven't been making payments on in 3 years. What are you talking about? And so they show him his report. Sure enough, another person with the same exact name is listed on his credit report. Well, so what do you do then? You've got to dispute it, and we'll come back to that in a little bit. So check your credit report. I'll say this again later, but you can pull 3 credit reports a year. Don't pull all 3 at the same time. That's kind of not the smartest thing to do. They're all going to be pretty much the same. Don't pull all 3 at the same time. But sometime throughout the year, pull all 3 of those credit reports. Make sure nothing weird is showing up on your credit. The faster you dispute it, the better. All right, so what else is on here? Your name, your spouse, or someone else who co-signed a loan with you. If any of you have a Graduate Plus loan with a parent or someone who co-signed for you, they'll show up on your credit report and all of that fun stuff. This one's a good example because if you see 2 social security numbers associated with your name, there's an issue.
I knew that.
Go dispute that. You'll see multiple addresses and things like that. That's fine. They'll usually have like your last 3 or 4 addresses, as long as you've had some credit reported while you were there. And sometimes even when you didn't. First time I pulled my credit report, it had my dorm room on it. It was a little creepy. But whatever, it worked. All right, next piece. Personal statements. This is basically anything that's kind of unique to your file, anything that they need to know. Like maybe a few years ago your credit card was hacked or your identity was stolen in some other way. And so you've got a credit hold on there. You're monitoring your credit. Anytime, for a while, because my credit was part of one of the big major hacks at the University of South Carolina years ago, we had free credit monitoring. And every time we would go and do an application for credit, they would first contact me and say, did you initiate this application? Yes or no. If it was yes, they'd go through with it. If it was no, they wouldn't. So this is kind of letting you know what you have on there. Your credit could be locked. There could be other locked files and things on there for a variety of reasons, usually court cases, things like that. You could have it locked down because you can put a lock on it so no one can do anything other than get the information here. But they'll say no information to give out. This account's locked, and that's kind of a red flag to banks and whatnot, but let your bank know about it ahead of time, like, hey, it's locked down because my identity was stolen by my parent or something like that. Unfortunate thing, but we've seen it happen. My parents, they had all my information. They took out multiple cards in my name as soon as I moved out of the house, and they had them mailed all there. That something like that. You can put an actual lockdown on your credit, let the bank know about it. Just give them the heads up on that. Otherwise, you're just going to get the instant denial instead of having them do a little bit of more digging. So what else? Potential negatives. This is the things that when you're applying for credit or even when you get your free FICO score from your bank, at the bottom it's going to say, hey, why is my credit this low? What are the bad things on my credit? On your credit report, it's going to be a lot more detailed. In this case, forget the name of our person here, but they missed a payment. However, that's like 5 years ago. It's literally about to drop off their credit report, but they missed the payment then, and so it's still showing up on that credit report. So just, if you miss payments, it's going to be on there a long time. And you know all those companies that say, hey, give us a call, we'll fix your credit. Instant improvement in your credit score. There's a few things they can do, but the reason they can legally say that is because they help you handle disputes. If you actually made the mistake, they can't do squat about it. All right, what else? Accounts in good standing. These are where we start talking about, what accounts do you have? What debts do you have? These are the other big piece. This is especially important when you're applying for loans and credit cards, because they're going to look at your debt to income ratio. They're going to say, okay, how much credit do you have versus how much debt do you have? So credit is, in another way of thinking of credit, is how much debt will someone let you get into before you reach your limit? So what's your usage of that credit versus how much debt do I have? My mortgage shows up on this one. Well, it shows that I paid off X amount out of however much I still have left. How much debt was someone willing to extend me versus how much do I still have? It's kind of like, are you going to have the money to pay back if I extend you more credit? Sort of thing. Or if I let you buy a house for students who are soon to graduate. All right, any inquiries on your credit? These aren't necessarily bad things. The inquiries aren't. Although a hard inquiry on your credit will cause like a 1 to 2 point dip for a short amount of time. If you have multiple hard inquiries on your credit across multiple months, you'll see a bigger hit to your credit that won't go away as quick. But if it's just one, or if it's multiple within the same month, that doesn't really matter. It's going to go down 1 or 2 points, not a big deal. It'll pop back up in about 2 months. So inquiries is just when someone is going to pull your credit. You go to apply for a credit card. You go to, apply for a Grad Plus loan. They're going to pull your credit. You go to apply for a mortgage. They're going to pull your credit. They want to know if there's a good chance that you're going to pay this back. Makes sense. When they stopped doing that, we had a housing crisis, and everything went upside down in 2008. It was awful. They weren't checking to see if people could actually pay back the loans they were giving them. Messages and rights, read it on your own time. We're not going over it. It's just a standard message that everyone gets. And disputes. So this is, of course, when you find something wrong on there, like, hey, I didn't take that credit card out. Yeah, I don't have a card for Best Buy or whatnot. That's obviously not me. You file the dispute. The dispute shows up there in this section until you actually have that dispute cleared. And they can choose to say, yes, you're right, that was not your account. Or we don't believe you, tough luck. Or maybe even we believe you, but we don't have enough information on who to assign this to, so we're leaving it on yours. That has unfortunately happened to a friend of mine. They're like, yeah, we know this probably isn't yours, but the name's so similar, they lived in the same area as you. Kind of tough luck. Had to fight it a little bit harder on that. All right. So now we're going to get into the score. This is what most people think of when we start talking about credit and do you understand credit and things like that. Again, every bank has their own system, and each one of the credit reporting bureaus has their own system to develop a score. We're using FICO. That's the most commonly published one. It's the one that most of you are probably familiar with. Well, 30% of the score is how much you actually owe. What's your outstanding debt? The biggest portion is your payment history. Think about it. They're less concerned with how much debt you actually have, although it's a big factor, than they are with whether or not you make payments on your debt. So they want to know your consistency. If you want to see what really builds a credit score, it's consistency. Then 10% is new credit. So some of you might be told when you get your score, hey, you haven't applied for a new account in a long time. And so, okay, well, they'll factor in whether or not you have new credit and that sort of thing. It also will hurt you because of the next one. Length of credit history. How long have you had the different accounts? How long have you been paying on these credit cards? How long have you been paying in this line of credit or something like that? And then credit mix. This is another place people get dinged a lot on their score because, oh, I've only got credit cards. I don't have anything else. Or in my case, I've only got mortgage and nothing else, and a car loan. So the greater the mix of credit, which shows there are different types of lenders willing to give you money, the better your credit score. You were about to raise your hand, it looked like.
So, say your parents are pushing you, or have pushed you, to open a second credit card for whatever reason, because it sounds like diversifying credit is glamorous. So,
that's two of the same types of accounts, so you don't really get credit for the mix on that one.
yes, but say you do it because, they told you to.
So we've applied for credit because our parents told us it was a good idea. Okay.
And your account becomes inactive because you didn't use that card. Does that ding you?
It can. It depends on how they look at it. For the most part, and I'm gonna look back to my credit card expert back here. You're self-proclaimed on this one. For the most part, you've got to use the card generally at least once a year for it to remain. So go buy your bubble gum, pay it off.
Gotcha.
That's hate to use the old example of it, but that's what they say. Or this card is now just my gas card and I will pay it off every month. Things like that. So if you've got a card, keep it active, use it. Plus, you also don't want to get any fees for not using it, because some cards will charge you fees for failure to use it. Because they're like, hey, we've extended you credit. It's costing us a little bit of money because we keep having to send you statements and whatnot. Dagnabbit, you better make us some money. And credit cards are businesses. That's what they are. They're not there for your convenience. They've just made life more convenient so they can make money off of you. All right. It really is. You play the game. But if you play the game well, you can have flights around the world for $52, right? Isn't that right? Yeah. You look like you're about to raise your hand, so.
I was going to say, the thing I do to make sure that they don't go inactive is I just set one auto bill to make sure it's at least each card has an auto bill, so that thing just goes to each month and then it pays off, and that way I don't have to worry about forgetting to use that.
Yep, so this one gets the internet bill, this one gets the light bill, this one gets the water bill, all that sort of thing. However you want to do it, if you've got them, keep them active. All right, so payment history. Do you keep your accounts in good standing? That is the biggest piece to the payment history part. And remember, payment history is the largest factor in determining your credit score. Do you make your payments on time? Next thing, if you are ever late on it, how often are you late? Is it like a one-time only thing across all your accounts? It's still going to ding your credit, but it's not going to be as bad as if you have multiple accounts that you're constantly late on. That will kill your credit faster than anything else. So, accounts owed. This is another huge piece. Available credit versus credit usage. You heard me mention this earlier. Your available credit is what is the maximum that, across all of your accounts, the maximum debt you can go into through these accounts. Your credit usage is then how much of that maximum debt have you used at the time that they're checking it. I talked with a student yesterday who had a balance and paid it off just after the holidays, but they ran their credit report while they still had a balance. And while it was still reported as having a balance, so their amount dipped, well, then the next month it popped right back up because they had paid off. So what are you using? All right. Both of these scenarios. Who has the higher balance? I'll give you a second if you need to. Who owes the most? They're the same. Correct. Who likely has the better credit score? Number two. Because number two's using less of their limit. They have a better credit usage ratio. So if you're going to have multiple cards, another benefit of splitting things up across multiple cards, in addition to keeping them active, is that you're showing a better credit usage ratio. So, your credit score goes up because of that. If you're only going to have one card, never keep a balance that's anywhere close to the limit month to month. If you ever have to keep a balance, then turn around and get that paid off as quickly as possible. Because when do credit cards charge you interest? On the month-to-month balance. You carry a balance over, then interest gets charged on it. Does anyone know the maximum rate that a lender in South Carolina can charge you on credit. Most have a maximum by law. In South Carolina, it's 28%. So in South Carolina, if the company is based in South Carolina, which most are actually North Carolina. North Carolina is the huge banking sector. You can have interest up to 28%. Ouch. All right. So pay them off. So how new and how much? Too many new accounts. So if you apply for like 15 new credit cards, I'm exaggerating, but if you apply for 5 new credit cards all at once and you take them all out, not as in I had 5 inquiries within the same month trying to find the best deal, but I actually took out 5 cards. That shows that I'm a risky investment in terms of giving more credit. If I'm doing that, what's going on with my finances? And they won't have the context of why you were doing it or whatnot, but they're going to wonder what's going on with your finances, and chances are they're going to say you're too risky to lend to. They're too risky to give credit to. So, if you're applying for new ones, by all means, please shop them around. Just don't accept every offer you get. Accept the best offer and only keep the best cards. Go ahead.
If you took one out recently, how much is enough time to get another one?
I would say there's not a hard and fast rule on that, and that's because, again, every bank, every credit card company has their own institutional method of determining. I would say probably, and this is just me gut feeling on this from what I've seen, probably a year between new cards.
You and your spouse get new cards. Is that showing 2 cards for yourself?
Are both of your names on both accounts? Then, yes, it does. Now, if you each take them out in your own names, which, by the way, most credit card companies, especially when they're giving like bonus points and miles and things like that, will let you do that, and then you get the referral bonus for your spouse, they get the referral bonus for you. You can totally play that up and take advantage of that. I've seen a lot of nodding back there.
Can I go off purpose question? If it's one account, but you like both of your names are on it, it only counts as one.
Counts as one account, but it will be reported to both of your credit score, or with both of your credit reports and both of your credit scores. All right, length of credit history. So this is where, how old is the account really comes into play. If it's a really young account, counts against you in this section. If it's a really old account, they love that. The older the account, the better. And when was the last time you used it? Have you let it go dormant, or have you kept it active? 8 years old. And quite frankly, some of you in here, I won't say most, but a good number of you in here can't have even had a credit card for 8 years at this point. Not everyone. Some of you are a little bit older, a little more mature, like me. But really, you're still going on the Backstreet Boys thing. All right. But some of you have had an account for 8 years or more. But until it's 8 years old, they consider it a fledgling adolescent account. It's not fully mature. The closer you get to it, don't worry, you still do get points up in this section. But once it's 8 years, they're like, nah, this person's good. History on these accounts during that time. So mix. This is where we talked about earlier. 2 credit cards is not a mix. It's 2 of the same type. But credit cards, retail accounts, installment loan would be like your car or your student loans. Finance company accounts and mortgage loans. All of these, the bigger your mix, as long as, again, you've had a good payment history on them, the better your credit score is going to be. You want to have the maximum credit score, you probably have to have all of these types of loans or debt and keep them all active. All right. So you've got a score. How do you improve it? I will tell you first, it's not a fast process. I think I've already said that today. But start by paying your bills on time. If that's the biggest factor in determining what your actual score is, well, don't you think you ought to do it? Makes sense. If your utility company, if your rental company says they're going to report to credit bureaus or gives you the option, yes, please. The more you can show a consistent payment history on absolutely anything, the better. And if they give you the option at all, tell them yes, as long as you're going to make the payments on time. If you're not, no, please don't. But better to make the payments on time. All right. Pay off debt and keep your balances low. This comes back to the credit usage. The lower we can keep that, especially if you can carry a zero balance month to month and show that you have full access to all of your credit at all times, you're going to have a better score. That's actually the fastest way of improving your score, is if you can keep those balances low, or if they're not low now, if you can get them low. Like if you're going, oh, I'll pay this off over months, I'd want to keep more money in my bank account. You're going to have to weigh that with how much money you actually need in that account. Don't close accounts. If you've got an old account that you really don't use much, put it on one of your bills and start using it, because you don't want it to go dormant and drop off your credit history. You don't want them to cancel it because of non-usage. Go ahead.
Is there a difference in paying off the state balance and the entire balance?
Well, if you're paying off the entire balance, you're definitely having a better usage ratio. Unless you absolutely cannot avoid it, I would never just pay off the minimum.
Like you can only pay like $25 a month as the minimum, or the last month, or you can pay ahead the extra 5 days from the end of the state to the end of the month. Is there a difference in those two?
Gotcha. No, you should not really. As long as you're paying off everything, it's treated the same. Yeah. No problem. Only apply for new accounts when necessary. Some people are going to disagree with me on that. Or disagree with me on the meaning of the word necessary. Is that probably where we disagree? Okay. So, apply for them when they're necessary. Or, I'm going to go on your side here. If there's something you're going to get out of applying for a new card, that is absolutely worth it. And it's got to be absolutely worth it. Not the T-shirt when they're out in your college. And they don't do that here because we're only 400 students. But, yeah, then just... Actually, that probably was illegal, and I probably shouldn't have done that. I was 18. All right. And if you find inaccuracies, dispute the inaccuracies. That's why you need to pull your credit card or your credit report. So, inquiries remain on your credit report for 2 years. So if you've had a lot of inquiries to your credit across, again, multiple months, if it's all within the same month, they treat it as kind of like a shop around protection, because you're expected to be smart and shop around for the best rate on different things, especially your mortgages. When you go to do a mortgage, shop that around and then make them fight each other on the rate. I've saved up to 0.5% by doing that, which you're like, oh, well, that's not much, Casey. Well, we're talking a house, not a pizza. I mean, 0.5% is a big deal when we're talking a house. But those inquiries are going to show up for 2 years. And so if you've done the multiple inquiries across multiple months thing, it's going to be any missed like that, anything that shows up on public record, you've got 7 years that's going to be showing up there. And by all means, unless you can absolutely avoid it, don't declare bankruptcy. That's 10 years of your credit being utterly shot. If you can't avoid it, you can't avoid it. That's just how it goes. But, by the way, student loans are not dischargeable in bankruptcy. So you can't do that to get out of your student loans. Sorry. That's why we like public service loan forgiveness. By the way, even if you have private loans, they don't count, which is disputable in the courts. But so far, the Supreme Court has not chosen to take that law up. There aren't shortcuts to improving your credit score. You can do it. It takes time. Better to build it well from the beginning based on what they build into that credit score, and just don't screw up. And if you screw up, make sure it's a once and done thing. All right. Things we've already said. Keep your balance at $0 every month. Keep the number of cards to a minimum for you. You like how I did that? All right. to the minimum for you, and check your credit up to 3 times a year. Do it every year. The more common your name, the more likely they're going to make a mistake. That doesn't mean that if you have an uncommon name, it's not going to happen, because it will. You can go to annualcreditreport.com. That's the one that the government has told the 3 big reporting companies that they have to do. Maintain that one site for everyone to have access to it. Or you can go directly to Experian, Equifax, and TransUnion. Directly there and pull your report from them. Again, 1 per company per year. It's a good thing to do. And if you get access to your FICO score on your bank account, a good indicator that something wrong has happened is if your score starts dropping. And you know you haven't done anything wrong. So watch that. And that's a good indicator of, let me go out there and use one of my 3 credit report checks this year. All right. Man, I talked fast. What questions do y'all have for me?
Just to make sure I understand, so you're saying immediately after you make purchases, go ahead and pay the balance off?
At least by the end of the month. Don't let it carry over month to month. Yeah, you don't have to go like, oh, I bought this today, let me go pay it off right now. No, you don't. That would get tedious. Like for whichever one you use for your gas for the car, end of the month, go pay that off. Just don't let it carry forward a balance.
And then the other question is, what are your thoughts on airline credit cards?
So airline credit cards directly, general rule of thumb, unless you are, is hypermiling the word? Mile hacking, sorry. Unless you're a mile hacker, you are probably going to get the 1 free flight that you got for signing up for the card. And after that, it might be 10 years before you have another flight. Now, when you're a doctor and spending that kind of money every year as an attending, different story. By all means, go for it. You can get one of those really heavy, like platinum card things, and as long as you pay that, look, those things are impressive. I've known one doctor here that had one. He handed it to me one day to go get lunch for the office, and he was like, "Here." I was like, "Gracious! I've never had a card that weighed more than a quarter ounce." No, that's impressive. And they tend to have much higher limits and much higher rewards because guess what? You use their card, they get a transaction fee every time you use the card. You then don't pay off a balance on a higher limit. Well, guess what? They're charging you 28% interest. Ooh. Don't be in that situation. But if you're going to pay it off every month, then maybe at that point in your life, they're going to be more beneficial. You'll get like a free flight every year or 2. And if you're gonna do the hacking thing on it, you're paying attention to where they're double and triple miles and things like that. Then you can really get a better benefit from it. Do you have to? Not necessarily, but realistically, you're probably going to get that for that. And it takes on average. Go ahead.
Other benefit outside of miles is that if you get like a travel credit card and your purchase points with it, depending on the card, a lot of them come with like trip cancellation insurance, baggage insurance, like laws, and a lot of other things like that.
Or free baggage if you're, with one of the airlines.
Yeah, it's the airline specific cards we do stuff like that. And ones with the really good protections are the bank cards, so like the Chase Sapphire, or the Amex card or something like that. But so it can like save you money like that way, even if it's just that you don't buy the trip insurance with like every flight or something like that. But if it does happen, then like they'll reimburse you just because you bought it with that card.
Yeah. So there are some added benefits to it. But again, that's more with the bank cards than with the like American Airlines dividend card or whatever they call it. You could probably tell me. I don't know. They advertise it to me all the time because that's who I fly with. But I only fly when someone else is paying the dime. All right. Other questions?
So in med school, obviously we're all like racking up debt for 4 years, but we're not expected to like repay it until after we're done with the repayment. Like, does this period of time when we're here, not making payments, racking up more debt, does that impact our score?
It doesn't drastically impact your score. Like medical debt, student loans are treated a little bit differently. It can impact it a little bit, but where it really is going to impact you is on your debt to income ratio when it comes time to apply for a major loan like a mortgage or things later. It's not going to have affected your score all that much, but they're going to say, oh, hey, you've got 300 grand in debt. Why do we want to also give you a mortgage? And to which you respond, don't worry, I can defer this debt while I'm in residency, and then I'll be making an attending salary. But if you actually defer the debt, I will find you and I will kill you. I won't actually kill you. But you can tell them that. And I will write you a letter stating that you are entirely eligible, required by federal law, that if you request this deferment, they will give it to you while you're in residency. I'll help you get the mortgage. That's fine. Just do make payments while you're in residency so that you can get the best benefit out of public service loan forgiveness or revised pay as you earn if you're going to be paying it all off. But no, it doesn't have a huge impact on your score. Does have the big impact on your debt to income ratio. All right.
You said if you're going to get like enough of a benefit out of a credit card just to go and get it, what would you like have that threshold be? Like a certain percentage of a certain category?
It's going to depend per person. To be honest, the only ones that have ever really tempted me were like the free flight. That's me. I like to travel. I don't get to do it much because I got to pay for 6 kids and it's expensive to travel. So it's like, oh, you're going to give me a free flight. Great. That one's been tempting. The greater the percentage back on things you're already going to be buying, by all means, go ahead. I think Discover is usually one of the better ones for that, but I could be wrong on that. And I'm not, please don't hear me say any of these names and think I'm advertising a company. I'm not. Remember, I don't even have any credit cards. But these are the ones I see and I hear about most often.
So I can
Go ahead.
So I think it depends on what kind of rewards you want. So I mean, there are ones that you can pay like an annual fee, and it's depending like how much you use in the month or year. So like for example, Capital One Saver one, like you can get that's a free card, gives you 3% on like groceries and dining. It just depends on like the percentage you want of that. So Bank of America has a Cash Rewards that's 3% on whatever category you choose. Chase Freedom is also a free one. It's like 5% on like certain quarters. So each quarter they give you like this year's or this quarter is I believe groceries. So it just really depends.
Lawson, I think we have your successor.
Yeah. So a lot of people just like regard like let's say Chase Sapphire because they have like a $95 annual fee. But if you spend enough, like the rewards can counteract the annual fee. It just depends. So that's why you'll find like if you do like a lot of business trips, you might get even the higher like tier cards because you get so much back. And especially any credit card usually has like benefits with it. So like my Chase Freedom one comes with like travel protections and rental car protection. So it's a really good idea to like go with credit cards and see what they offer you.
Yeah. Be specific about which ones you want, but for every one of you, it's going to be a different answer. It really is.
Going back to this question over here, I was just curious, having spoken to some of the banks that do the physician loan, they don't care, they don't calculate your student debt at all.
Nope.
Your debt into a ratio.
Exactly. And it's because of that letter that they always ask me to write for y'all. Yeah, about being able to defer your loans. Because they're like, they don't have to make payments on these. It's not part of their debt that they're going to have to deal with while they're in residency. You're still doing it. But I'll write you the letter. And they know that you don't have to make payments, and that's why they leave it out. They also, for physician loans, and actually residency and relocation loans for those going into M4 year, you can get a residency relocation loan if for some reason that your student loans run out or you run out of eligibility there. It's a way to kind of get you that next bit of loans. It's a private loan. They're great in an emergency. Stick with federal loans if you still have eligibility, but it's another one. And again, they treat it very similarly, where they know y'all are going to be doctors. Doctors have a default rate of less than 1%. You're a safe bet. There's a 99% chance you're going to pay them back what they gave you with all the interest that's owed. So they're willing to take some extra risk on you.
How does that change even if you don't defer though? I mean, if you have a small enough mortgage that you make your minimum payment on a pay or a repay and your mortgage,
It doesn't matter at that point. They've already given you the mortgage. Yeah. They don't care what you do after they give you the mortgage, so long as you pay your mortgage. Yeah. If you're, and it's been offered to you. It's one and done. They're not going to come back and take your house at that point unless you commit a grievous offense against them. There is always an acceleration clause, by the way, on pretty much every type of debt that you take out. Acceleration means that all at once, because you did X, Y, or Z, we can come at you and you have to give us the whole of it back right now. Like even with your federal student loans, there's an acceleration clause, but no one knows of any cases of it ever actually being used. You'd have to actually go in and commit fraud. And
I was about to ask, how would you pay it back? Because you can't declare bankruptcy because bankruptcy doesn't eliminate your student loan. So that's just a circle.
Mm-hmm. They know it. It's better not to use that clause to at least get something out of you. Because if they use that clause, they can garnish your wages and things like that to where you've got just enough money to live off of and take everything else. But they can do that anyway if you're in default. They don't have to accelerate the loan. But basically, keep things legal. They'll never do anything like that to you.
Casey, what's the instance again in which, like, I'm deceased? Like, what do we have to do to get that again?
Okay, so did you say what do we have to do to get dead?
No.
Okay, did I hear that wrong?
Well, that's what I said. I don't think it's what I meant. What I'm trying to say is like that.
If something happens,
No, that thing that you were talking about where you're like, okay, you can do that, but if you do, like, I'll kill you. Like.
Oh.
Like what? Like why is it bad? And tell me why it's bad.
So not making payments on your student loans while in residency is bad because especially if we're doing public service loan forgiveness, you have swapped the ability to make a zero payment for extra $1,600, $1,700 a month payments at the end, as opposed to a $300 payment in residency. It's poor financial decision.
I thought it was surrounding mortgage. I thought that was the instance.
Oh, yes, it was about the mortgage. I said, I'll write you the letter saying you're eligible to defer, but if you actually defer, that's when I find you and kill you.
So you're saying that is a bad idea?
Don't defer unless you just absolutely cannot.
This is a little tangential. What is the scenario in which it makes more sense to pay or repay to the 20 or 25 years versus using one of those to achieve public service?
It never makes sense to pay 20 or 25 years on your student loans. You have a much better...
I can't figure out if you don't, no resident can afford, well, depending on the size of your loan, you can't afford the full.
I've had like 2 people that I've ever advised to make full payments while in residency.
You have to pick a pay or repay unless you go out of public service. Like if you go to private practice, then you'd have to finish 20 years.
Then I wouldn't take 20 years to do it. At that point, I'd just pay it off.
But,
And
that's your timeline.
that's the maximum timeline.
You're saying a publicly employed place, there's never a scenario in which it would make sense to follow up, pay or repay.
Yeah, if you're in a public or nonprofit location for your student loans, again, as long as the money part of it makes sense, like your income versus the payments and things like that, it always makes sense to do public service loan forgiveness if the money shows that it makes sense to do that. If you do then go private, then it makes sense to start accelerating your payments from your side.
What about the private practices that establish under a 501c3? Are you still public even though you're private?
Are you talking about like Prisma owns like 1 million different practices that are established under them? So under the yeah, those are still public. Those are still nonprofits.
Own practice and set it up as 501c3.
Then you'd probably be fine. Yeah, it's a bit of a pain to set up a 501c3, speaking from experience, but if it becomes worth it to do so, then yeah, go for it. Welcome. By the way, on the death topic, different types of loans, different things happen if you die. Credit cards then get charged against your estate. So if there's any money that comes from you dying, your credit cards will be paid off. If there's not, they'll come back and try and repossess the things you bought. Your mortgage, again, charged against your estate. They'll repossess the house if they can't get paid for it, or if someone else doesn't just buy the house. Your student loans go away. So if something happens to you, your student loans are gone. They don't go to your family or anything like that. This becomes relevant because especially my fourth-year students ask me all the time, how much life insurance do I need? And the answer is, if you've only got student loans and have no dependents, Zero. You don't need it. That said, I'll still probably take whatever my work gives me really, really, really cheap. Because, like, I'll use mine for example. I have nearly $500,000 policy. I pay $10 a month for it. That's worth it to me. If they're going to charge me, on the other hand, $200 for the policy that in my case, I actually need because I've got a lot of dependents, that's a different story. But for a who doesn't have any dependents, who doesn't have any debt other than their student loans, you don't need life insurance other than what your employer. Most employers will offer a percentage of your salary as a life insurance pay for. Just like, hey, you work here, we value you enough that if you die, we'll give someone a little bit of money, and that'll usually be enough to bury you. And I tend to be pretty blunt about these issues, but that's literally all most people need. Now, I've got a mortgage and a spouse. I need more life insurance in the event that something happens to me to make sure that my spouse is okay and that they'll be able to handle the mortgage, either to pay the whole mortgage off and then have a little bit left, or to enough that it'll supplement my income while they get back on their feet or continue doing what they're doing. That's a whole different topic, but that's just in a nutshell on that.
That isn't associated with credit scores. How is it dealt with?
So it will show up on a credit report, but it's treated about like student loan debt on it's just kind of ignored for the score for the most part. Until it hits collections. That's a different story. Because at that point, you've got a delinquent payment history. That's treated different as opposed to just, not being part of your normal debt. So it can still be detrimental. But generally speaking, it's not. Any other questions? Saw a hand. You were just stretching? Okay. All right. I'm seeing none. Man, I'm going to have to cut a lot off at the end of the recording on this. It's set to go to 1:15 in case I talk too much. All right, y'all. Thanks.
Thank you, Casey.